Welcome to another What's Up with the Market session. Going to go through the indices, the major indices, and today I'm also going to go through some of the commodities as well. A couple of little changes over there to take note of before I get into, and then we'll do a Q&A at the end of the session. Before we get into it, I have to tell you everything we cover here today is of a general investment advice nature, no specific or personal advice, and past performance is not a reliable indicator of future performance. Okay, let's change over into Beyond Charts, and we'll get straight into the analysis. Starting off with the sound is low. Let me bring this a bit closer. How's that? Starting off with the Dow Jones, and I'll shout a bit. Starting with the Dow Jones. Now, there's a pattern that I've picked up in doing my analysis and preparing for the session, and I prepared with yesterday's data, and there's one more bar added since then in the US session today, and that there's a potential continuation pattern that's formed in all of the international indices or the US indices, and I'll talk about that in a moment. But firstly, we certainly have a retracement here in the Dow Jones. Dow Jones was outperforming the S&P 500, a little bit of outperformance, and now underperforming the S&P 500. And typically in a bull market, that's what we'll see. We'll see the broader market, the S&P 500, outperforming the Dow. So that's not that's starting to happen. It looks like it's starting to happen in the S&P 500, because that's what I'm comparing this bottom chart to. That's a relative strength chart at the bottom. So comparing a ratio between the Dow and the S&P 500. But the pattern that's forming here, and you'd be familiar with these trend lines and support and resistance zones I've got here. This black dotted resistance zone at the top here is the all-time high that the Dow Jones has achieved. So certainly we've climbed up from the bottom of September last year, about a year ago, when the troughs were hit on the US indices, and slow climb up, a bit of sideways, a bit of a breakout, and now going sideways to down. But the symmetrical triangle, which is the magenta triangle that I've drawn over here, and that's going to be the theme for today's session, is a continuation pattern in the direction that the market was going prior to that symmetrical triangle forming. So that should be a continuation pattern. Now we have the US indices in today's session opened higher, went low, and then finished not quite with buyers in control. By that I mean the close wasn't above the open, but certainly was way up near the top of the bar or the candle, depending on what you use, meaning that buyers did end up in control after what happened through most of the session. So that's a bit of a positive. Now, when we go down to the S&P 500, you can see the symmetrical triangles formed there. And what you would have heard me say many times before when I've looked at these patterns is that there's an apex forming where the market runs out of room, if you like, if you think about it, and there's going to be a breakout one way or the other, up or down. And when you look at technical analysis, it does the initial breakout isn't always what pans out over the next 2 or 3 weeks, and that typically happens a lot with breakouts with stocks. You'll see on the upside, and then then there's a failure, and then it falls down, and the pattern doesn't continue. And effectively, then the symmetrical triangle becomes a top. So there's not 100% dead cert for any of these technical analysis patterns, but on a large sample, the symmetrical triangle is a continuation pattern. So we've seen now in the S&P 500 a bit of a break below this lower trend line, which is the bottom part of the symmetrical triangle, and then buyers ending up in control. Now, too early to tell which way this is going to go, but the odds are over a large sample that this is a continuation pattern, and we'll eventually see a breakout on the upside, to the top, and then the next bit of resistance will be this blue resistance zone up here on the S&P 500. How far are we away from the all-time high? Well, that's all the way back over here, and I'll extend that resistance zone in the next session we do in a couple of weeks' time. Down the bottom here, I have volatility on the S&P 500. It's pretty low, down at 0.885. That's a low volatility for the S&P 500, which is also indicative of bullish conditions as well. So we've got a retracement here. How does a symmetrical triangle form? Well, you have lower highs and higher lows coming up at the bottom, and eventually you have a breakout. So we're still within this channel. The other point to note here is that from the run-up of the trough from September, or from middle of October last year on the S&P 500, so some 11 months we have had on the Fibonacci I'm looking at now, the deepest retracement we've had at this particular time here is a 23.6% retracement. So that is shallow, and it's still working its way out time-wise from the peak there to where we are now. Pretty textbook stuff. This is what you'd expect for a shallow retracement in a primary bull market. So even though we've had a retracement here, the odds are still in favor now of this primary bull market continuing, which is within a secular bull market, which I'll cover in about about 6 weeks' time. I'll do a secular bull market update. So things are still looking okay, but there's no guarantees here. We do want to see for this pattern, this continuation pattern on the upside to continue, is a breakout above certainly the first peak, then that peak, and then to make a new 52-week high and take out this peak that was achieved back here in July. So that's the case for the upside. The case of the downside is that we see a sharp breakdown here, break through the 23.6% retracement line here, which is 4343.81, and then even break below this trailing stop here we have on the SPA 3, on the algorithm, the buy-sell algorithm, we have a SPA 3, which is where the entry was back over here in April. So this trend is still up. We've got some room here above the trailing stop. So things are still positive, and this is an environment in the US market, if you're running US portfolios, that you should be 100% invested. That's what you should be in. This is an uptrend, right? Now, there's a lot of negative news going about. You heard me, I'm always on about the noise. We've got to get objective and focus on the price action. And if you're focusing on price action and shutting down all the noise, turning it off, then you would be 100% invested in the US market. Now, this is the cumulative new high, new low. A bit of the top over here is showing that's the symmetrical triangle on the S&P 500. That's what that blue line is. And we're not seeing a run up here in the breadth of market. It is rising on having more new cumulative highs and cumulative 52-week lows. So not negative there. That's all we can take away from that at the moment. And on the cumulative advanced decline line, no negativity here. So I won't harp on about that too long. And certainly in another breadth of market, the number of stocks in the S&P 500 that are above their 150-day moving average, round about the middle. So no signals here or signs here of either raging bull or raging bear. So nothing to analyze there. On our sentiment indicator, looking at the consumer discretionary versus the consumer staples, a bit of a symmetrical triangle forming here as well. Just zoom in a bit. What I'm looking at my analysis here is certainly the buy-sell algorithm, the ATL trailing stop that we have in SPA 3 Investor is an open trade, pretty shallow retracement there. But what I'm looking at is this Ciroc over here, this 5534 Ciroc, which is on this relative strength line. This relative strength line is measuring the strength of consumer discretionary versus consumer staple. And we want to see, for a risk-on type environment, we want consumer discretionary to have the upper hand, which it has at the moment. So that sentiment indicator is telling us it's a risk-on environment. Okay, this is the one that I'm worried about the most for the case of a bull market continuing, and that is the strength of the US dollar. And you can see, just zooming out a bit here, that certainly looking at the Ciroc is saying the US dollar is rising. That is the basket US dollar against 6 other currencies, one of which is the yen, which we're going to have a look at the Nikkei in a moment, because there might be some indications there of what's happening. But effectively what this means is that there's money coming into the US, there's money going out into other currencies, but not enough. We want to see money coming out of the US dollar going to other currencies, because that means other currencies, that means money is going to other markets. And we're not seeing that at the moment. We're seeing it, staying in the US dollar. So typically there's a negative correlation between US dollar and stocks, and it's quite a strong one. When you download this analysis, you can go back and look at all the buy and sell, see what the correlations are. But it's not 100% dead cert, but it's a stronger correlation than 10-year yields, or if you look at either the yield, which we'll look at in a moment, or if you look at the ETF on 20-year yields. So this is my biggest worry at the moment. And if this US dollar continues to get stronger and stronger, and the trend is certainly up there, it's going to put a handbrake on equities in the US market. Volatility, the VIX is near pretty much lows. So you can see there's the extreme low, the bottom, the black channel, the black bottom horizontal line over here, and we're down near the bottom. So as I said, from the S&P 500 chart, volatility is low, and that's typically indicative of a bull market. Okay, onto the NASDAQ. You can see the NASDAQ here. What we're looking for, a risk-on environment on the NASDAQ, is for it to be outperforming the S&P 500, which is what it's doing over there, kind of flat to sideways here. But I've got this, I've got an indicator here at the bottom, which is a fairly medium to longer term CIROC, which is a CIROC on the relative strength line over there, and that's still rising now. This can stay up above 90 for long periods of time. So that is still a risk on. Having said that, this trade that was done in the index, if you like, could have been done in triple Q. Using this buy-sell algorithm here, did give us exit signal on the NASDAQ composite, but there is a symmetrical triangle forming over here. So all three of the major US indices have symmetrical triangles, which are continuation patterns of the trend leading into the pattern. So that is definitely one of the patterns, if you like, looking at that is indicating a risk on. So is a CIROC indicator over here, but we do want to see the NASDAQ start outperforming the S&P 500 again. And that's going to be also be a little bit contingent on what happens in the US dollar. I'd like to see some weakening in the US dollar to really put forward the bull case, the bull market case to continue here as well. But there are signs certainly that the bull market is still a risk-on environment. And if you are fully invested, you should remain fully invested and not be running for the hills at this stage. Okay, this is the cumulative high, new low on the NASDAQ. You can see a little bit, and that's the index, the blue line up there of the NASDAQ composite. And you can see that there are now more new lows than new highs being made in the NASDAQ. So we would like to see our, one of our risk-on indices, if you like, rising, and this cumulative new high, new low indicator, breadth of market indicator, rising rather than falling. And that's telling us that, because that's just looking at raw numbers of the number of stocks actually in the NASDAQ 100 it's looking at, is that there are a few stocks that are holding this up, and we know that quite well. There's a lot of noise being written about the fact that it's really a dozen odd stocks or even less that are pushing up the market at the moment. So we do want to see some more breadth of market. Some of the other breadth of market indicators are up there when we look at the number of stocks above the 100 and the 150-day simple moving averages, and certainly in the advanced decline line, it's showing that as well. So here we can see there are more than half of the NASDAQ 100 stocks are above their 150-day moving average. It's a little bit better than the S&P 500. So it's not just the large cap stocks, the FANGs as you want to call them. There are other stocks that are rising as well. Okay, onto the Philadelphia Semiconductor sector. This is a sector index. It's actually an industry index, so it's not one of the JIC sectors. And been marshalling this also for risk on environment. You can see the CIROC here, the 5534 CIROC, which is the ratio line over here. So really what we're doing is I'm comparing the semiconductor industry to the NASDAQ composite. Right, so even though the NASDAQ is a risk-on indicator, I've got even a higher risk sentiment indicator, if you like, which is the Philadelphia Semiconductor Index, and that has been in a stronger uptrend than what the NASDAQ composite has, but has just fallen below this lower channel line over here. So an early sign over there. We don't want to react on 1 or 2 or 3 or 4 or 5 bars. We want to see a bit more evidence than that. And this indicator here, the setting I've got on it, the CIROC, is really for a medium to longer term environment. So we'll give this some leeway, and we'll see what happens with the ratio between the semiconductor index and the NASDAQ. One to keep an eye on, as are the symmetrical triangles that I've taken you through so far. Okay, just bonds yields on the Treasury note is still rising. It's up at 4.36%. Although it has kind of gone sideways since about a month ago, 3rd week of August. But this indicator rising over here is on the moving average of the ratio line over here. So it is the yields are outperforming equities at the moment, and that's what this is showing over here. However, as I said in the last session, I'll repeat it again. for those of you who don't forget, because I do forget, is that there isn't a stronger correlation between yields and equities as what there is between the US dollar basket and equities. So this is one that you shouldn't put too much into, but obviously the newspaper and the noise talk about this one a lot. It's not as strong a correlation if you go back and look at it historically. Okay, looking at the All Ordinaries now in Australia, a bit of a symmetrical triangle formed over there as well. We've got higher lows and lower highs. The apex looks like it's still some way off over here. It's not as close as the US markets, but we do have the Australian market underperforming the S&P 500. That's what this blue ratio line is showing us over here, relative strength line. And the sideways market, this dog's breakfast continues on the All Ordinaries and been going for over 2 years now. So what is the direction of this symmetrical triangle? Well, basically sideways. So it's nowhere near as meaningful as the symmetrical triangles that we saw on the US indices. Okay, just looking at the Australian dollar, still continues in this long, big downtrend, which effectively means that there's not money coming into. People aren't buying the Australian dollar versus the US dollar. And really, for what we need to see is some small to medium cap commodity type stocks start taking off in Australia to see money coming. That's when the money comes into Australia for resource stocks and large cap stocks as well. That's when we see the Australian dollar start rising against the US dollar, and that's when we typically see our market taking off as the Australian market taking off. That is as I've said many times before, see this as the share price of Australia. The Australian dollar versus the US dollar, and its share price of Australia is not going up at the moment. Okay, just one last international index I want to look at, and that is the Nikkei. Nikkei has, if you go back and look over a long period of time, I'm just going to go to all data so we can get the 1989 peak in here as well. Right, where is it gone to? Well, we'll just zoom in at the moment. Oh, lost my... Come on, didn't like it. Okay, there we go. So that's going back to 1965 or something, but there's the 1989 peak in the Nikkei index, and this Japanese market has continued in this long-term trend, which started basically here in 2008 and has been inching up towards this peak that so effectively been in a secular bear market since 1989. But what I wanted to bring in, it's not that far off that all-time peak that is achieved back then, but there's been a breakout here. So this is the buy-sell indicator, ATR trading stop / breakout indicator, Inspire 3. There's an ascending triangle that's formed over here. This is the recent peak, bumped its head against this a few times and is now attempting probably the 4th time to get through this breakout. And if it does, that could be quite significant. And that would take money out of the US dollar into Japanese yen, which would play a role in weakening the US dollar. And that might be what triggers this whole next leg up if the bull market case continues up. So keep an eye. You can see that the Nikkei has been outperforming the S&P 500 for some time. Even in the sideways movement market, it's been outperforming as well. So Nikkei is one to keep an eye on from international indices at the moment. For the bull market to continue. Okay, so the flip side of that is that obviously if the international markets all go sideways to nowhere and go down, then there's going to be money going to the US dollar, which is probably going to just take the edge off what happens in the US market, equity markets. Okay, just quickly go over to some commodities. The CRB Index, Commodity Resources Bureau, or now it's called the Core Commodity CRB Index, has also broken this downtrend over here. So uptrend, downtrend, pretty normal stuff. Breakout above the upper channel line, a bit of relative strength over here against equities, showing commodities starting to outperform equities a wee bit. Not enough evidence there, but it's certainly starting to happen. And if we go down to gold, there's this high that was achieved back here in 2020 and been going sideways. But I've still got this black channel line. I've drawn a gray channel line over here, downward slanting channel line, a bit of outperformance over here of gold against equities, but I've kept this light gray channel line over here because we had a breakout, came back into the channel, another breakout, and now we're finding support at the upper channel line over here and then a rise up. Now, the gold price, the trend is still down, So no gold bugs shouldn't be rushing into gold stocks at this stage, but based on this, but if you get signals in gold stocks, you certainly can. But this is just really an early green shoot sign that maybe gold has found some support over here, and it's at least going to have a run up to its all-time high up here, just below 2100. So a bit of green shoots happening in the gold price over there. Silver, nothing to really mention. Copper, which is one of the bellwether commodities, still in a downtrend, bouncing off this upper channel line going down, and also this resistance zone over here, and underperforming gold. So no signs there of commodities or the resources side of the market starting to pick up. Certainly not in copper stocks, which is a bellwether for other commodities as well. Copper is really the main cause of the CRB index rising, and this channel line continues. The channel continues up over here and looks like it might break out the upper end of this channel, which would really change the gradient of the channel and just say and just point us as the gradient changes, and it is a bit, you can see it starting over here, that if it breaks out the top side and the gradient does become more acute, that bull market is stronger and has more momentum. Right, just looking at Bitcoin and the signal over here, these down little wedges coming down over here really are there's a longer term uptrend over here. I haven't redrawn this channel yet. I might do that depending on what happens in the price over here, but looking for a breakout for the bull case on the up case to break out above this channel, the upper channel line and the black channel, down channel over here. But an early sign in the Ciroc, and I've got a fairly short Ciroc on this, medium to short term, 26.9. And there's been an entry signal occur over here with the blue crossing above the moving average, and let's see if that continues. This Ciroc line, this momentum / trend indicator, does work quite well with that period setting for Bitcoin, as it does on Ethereum. And you can see Ethereum, the crossovers just happened on the latest bar as well. So keep an eye on those two main cryptos. There could be breakouts out of the channel to the upside in the next week or two. The uranium is going gangbusters. Just zoom out over here. So all-time peak back there in 2007. Some resistance zones over here. The gradient of the up channel has changed to a bit stronger. Now, people talk about URA as the ETF that you can go and trade with if you want to get exposure to uranium. That's other than uranium stocks. But this is the relative strength line of the URA ETF to the uranium price. And you can see an ETF is supposed to track its base index. It doesn't do that, the ETF. It kind of runs ahead and then falls behind, runs ahead, falls behind. And this relative strength line is telling us that. And you can see at the moment, the URA has run ahead of the uranium price. And what you might see is the uranium rising and URA going nowhere and having this kind of retracement over here where it's actually weaker than uranium price. Now, in this instance over here, and you can see this one as well, in both instances, the uranium price was falling, but URA fell by more than what the uranium price did. So if there's any weakness in the uranium price, then you might find that URA falls at a faster rate. So it doesn't track what's happening in the uranium price. But uranium stocks are certainly stocks you can go and look at the moment, wherever you can find them in any market of the world. And Australia certainly has some. Iron ore, last couple of charts to get through. There's a downward channel breakout, come back, retest the upper channel line here, found support, rising again. And this is a weekly chart, so it takes a bit longer to get bars forming here. This is this light gray upper channel line I put in here. There is a breakout. So there's an early shoot here, higher lows, lower highs, a bit of a symmetrical triangle forming here as well, which would typically be a continuation pattern. And that continuation pattern being such a wide one and running over a few months, in my technical view, would be a continuation of this uptrend, this very wide uptrend that started back here in 2015. So keep an eye on this trend line, this downward trending light gray trend line over here to see if this breaks. If it breaks above, got to break also break above this resistance zone, this blue resistance zone here, just below $130. And in which case, obviously, iron ore stocks would have a crack again. And lastly, just looking at thermal coal, there was that all-time high that happened not that long ago, back here around about September 2022, a year, acute, pretty sharp downtrend, a breakout above that at a pretty weak resistance area, only a couple of touches there. This is the third touch. Let's keep an eye on thermal coal to see if it breaks and goes higher. Okay, that's what I wanted to cover today. The theme is the symmetrical triangles that are formed as continuation patterns across the indices. And there I'm showing the S&P 500. So on to questions. Hi, Gary. This is from Don. Could you please give us an update on the pipeline of the new system developments? Certainly, Don. The system, I'm assuming by that you mean the SPA3 income. I'll come back to SPA3 income in a moment. Right. From a SPA3 investor perspective, we've created a whole new development environment, which makes it far easier to do research on particular ETFs and stocks or even indices. And we're rolling that out into development at the moment. So probably early in the new year, we will be able to, or even later this year, we'll be able to add, rather than doing a big chunk of research on a whole lot of stocks, we'll be able to add stocks and ETFs fairly quickly. Onto SPA3 income, where my research has got to on that is a bit disappointing from personal perspective, but I'm sure also from what you're going to hear now, is that I've been pursuing using options to as the instrument through which to generate income, and that and in doing so, I've wanted to set a goal to mechanize that as much as I possibly could. So, and that is stalled at the moment. So there are options I've got of what we're doing some research at the moment and looking to maybe expand and make that research a bit deeper with respect to that, but way too early to tell. But that whole development, which has been going on for some years now, has basically stalled. Okay, and other developments, new system developments, are all developments in terms of the beyond charts and functionality there. We did say new system developments. There's ongoing research and really we're now in a monthly cycle of pulling out new versions. There is also research going on in the area of leverage, the leverage portfolio, which I'm trading live at the moment, and I do put have been for some time. It's actually, leverage portfolio has done pretty well on the US markets over the last year, up over 100% on that equity curve, but on a huge drawdown that came before that, which we've now addressed with a whole lot of research that we released last year. And we're doing more research on position size and position risk of the on leveraged as well. So there's a whole lot of things happening in the background, and I know I don't give you updates all that often, but when we have something to provide, we certainly will make a bit of a noise about where we are with it and where the research is. So there is research going on all the time. There's development going on all the time and beyond charts product, and we are establishing this new research environment, which has really taken quite a few hundreds of hours of development to put into place. And when that's in place, we'll be able to get through our research a lot quicker. Hopefully that answers the question. It's never a dull day here at Sherwell Systems. There's always stuff going on in the background. Now, are there any questions about the market status update? If not, I'll end it there, and thank you for your time. Certainly you can ask questions wherever this video is posted. It'll be posted in in Kajabi in the Education Center, but it'll also be posted on YouTube as well, and feel free to ask questions over there as well. Right. Nicholas, have you got to ask a question? You've raised a hand. You can ask it in the chat box if you can find that, and I can answer it there. Otherwise, certainly go to YouTube and ask the question, or ask it in the Education Center, and I'll end the session there. Thank you very much for your time and attendance. Hopefully you've got the message. Keep an eye on those symmetrical triangles. And as always, I wish you consistent and objective investing.